Hey, well, good afternoon, everyone, and welcome to BSFI Tech Talks. And just in background, BSFI Tech Talks is a platform that's focused in the fintech sector and small businesses, really providing value through our partnership and alliances. So we are very happy to have Leon Kassab, who's the co-founder from Hydra Ventures, with us this afternoon. I have a nice opportunity to talk with him with regards to about his organization and his strategy. So, Buck, I'd like to turn it over to you.
Thank you. Thank you. All right. Thank you, Leon, for joining us, and welcome everyone on this webinar today that we believe is going to be very special for a lot of startup founders, especially who are, working with complex technology solutions. So, Leon, we are going to start with a question that comes to everyone's mind. In fact, it came to us in last 4 weeks after we announced this webinar as to what is anti-fragile, why do you put so much emphasis on that, and is it something very technical or is it something that all entrepreneurs can understand and practice in their own business areas?
Hello, thanks by the way for having me. This is a great opportunity, so appreciate you inviting me on. So about anti-fragility, it sounds like a really complex word, but what it really means is bulletproofing your business. The concept going back in time was developed by a hedge fund owner and then also a trader named Nicholas Taleb. And his whole concept was to, in both personal life as well as in business, to remove risk and get ahead of black swan, phenomenon that might happen. I think we're experiencing a few of those right now. Folks in Texas are experiencing a black swan event, and so are we during this pandemic. So Taleb's thought was get rid of risk by not taking on too much debt and thereby set yourself up for the best possibility of success in your business and life as possible. So to reiterate, we like to use big words and make us sound fantastically smart, but words such as anti-fragility has that connotation, but really what it means is be smart, don't take on too much risk, and set yourself up for success down the road.
Okay. So it is something all entrepreneurs can understand and practice.
100%. And I would argue everybody should be anti-fragile. So what we're seeing, especially now, is to bulletproof yourself, to remove risk, you need to have as little debt as possible and be open to as many opportunities as possible. Now, how is this achieved? You have a business plan that makes sense, you have product market fit, and you have technology implementing or helping you build that and scale that business. And that's something that we've seen. The last part, everybody likes to talk about technology. This group is about fintech, and everybody likes to talk about it, but not everybody has a firm grasp on operating and executing a plan that's related to technology.
Mm-hmm. Thank you for that. Ross, you had something to ask Leon?
Well, I think, Leon, the whole concept is certainly different. And when people hear anti-fragility, they wonder, well, what exactly does that mean for the business owner or the entrepreneur? And I think you've kind of gone into that. Would you say that it's primarily an anti-debt focus on establishing a structure for a business and then moving on to growth? Or is there another component to it that maybe I'm missing when I'm asking to you?
Great point. Great question. So it's not anti-debt. It's taking the appropriate debt, because debt, as we know, can be leveraged. So if I'm a business owner, I'm not going to go buy a Picasso and hang it in my office and then not have operating capital to fund my technology stack. So what it really is about comes down to is making smart decisions, having a plan, and operating / executing 100%. We talk about technology and businesses. Everybody has a, generally speaking, when you start a business, whether it's fintech, it's consumer products, whatever it is, you have an idea. The idea is to create something or provide a service. So, but the person that's having that idea oftentimes isn't that technical. But in today's world, technology is a key piece of being scalable. So how do you manage the two? How do you, as a idea person, how do you implement technology without breaking the bank, without getting taken advantage of, and allow yourself to scale? That is what we think of as anti-fragility, making sure that all the pieces that are needed to have in place to be successful are there, are thought of and are there for you. So in a simple term, don't take on too much debt, don't give away too much equity, just do the bare minimum to allow yourself to scale the way you want to scale.
And in fact, Leon and Ross, I will add one point to what Leon just explained to us, that debt need not be seen only from a monetary perspective, but even technology causes a huge debt. When you make wrong choices about selecting your technology or platforms or languages or anything else, every new feature that you add creates 5 more problems down the road. So that is also a debt that you are taking on, which sometimes can be actually more serious than the monetary debt.
Yeah, that's true. It's really interesting, Leon, also, as you kind of talk with regards to what you do and the role of what your organization does. What is the typical lifestyle of your relationship with a startup? I mean, do you start at a particular point, like say pre-seed, or do you engage them throughout their life cycle? From your perspective, what's that preference and that sweet spot, as far as where you target?
The interesting thing is we don't have a sweet spot. We like working with everybody, and we are stage and industry agnostic.
Okay.
So to give you some examples, we have companies that have been around that we worked with that have been around for 10 years that come to us and say, hey, we're at $1 million in revenue and we've hit a rut. How can you help us achieve this? Specifically, I'll give you an example more robust. We had a company come to us that was in the talent management business. They work with all the big talents, like models and stuff around the world. And they came to us and they say, we book about $1 million a year, but we've been booking $1 million a year for the last 7 years. And we are having a hard time actually being positive in terms of net income and even paying our bills. How can you help? So we took a quick look at it and said, this company is worth at least 20-30 million in revenue within a year. And we set up a plan for them to use technology, get rid of all the ancient way of we've always done it this way process, and put technology in there that allowed them to do everything seamlessly. So that's one existing company. We're currently working with a founder in Hong Kong to scale up and spin up his entire business. He's in consumer products, and we're doing something really interesting with him, and that's ground up development. We're building everything from scratch, the payment processing, the referral technology that we're developing for him, the bank integrations, everything from scratch, and making sure that he's not a technical person. So we're making sure that he's not taking, to Buck's point, on too much technical debt, nor is he not building a business that can scale. So we're preventing it to make sure that it's we're making sure that it scales, not preventing it from scaling.
Perfect.
So,
Yeah.
so those things. One third example, just for your reference, we had a e-commerce business come to us for help late last year, and they were in just below $1 billion, and we helped develop a roadmap for them to go to the next billion. And everything is technology related. Everything is related to how you interact with the customer, what systems are needed, how are payments made. All of this are always thought out and developed and then executed against. So in a long-winded way, we don't have a certain type. We work with everyone. The only caveat is it has to be scalable, and we have to be able to make money through our venture operating model on it as well.
Perfect. No, that's great. Thank you.
Perfect cue, Leon. I was just going to ask you the next question about your venture operating model. I have seen your operation for last couple of years, and I saw it kind of emerge from your consulting business, and as you accumulated more and more experience. So tell us a little bit of history of how it evolved and what does it offer to the customer or the partner that you work with, and more maybe at the end of it. Also, I hear from a lot of people as to how your integrated approach in the VOM gives a better quality of experience to an entrepreneur as compared to a discrete VC and discrete technology partner and discrete marketing partner, that kind of thing.
That's perfect. That's a lot to cover. So I'll take them one at a time, and please ask questions if I'm not hitting what you're trying to have answered. Venture capital is a great opportunity, but it's not for everyone. So again, if you remember the anti-fragility positioning that we do, we want you to take the appropriate levels to scale. Venture capital can be great for some companies. If you are purely in need of money, venture capital is there, and you need it quickly, and you need it in a way where you don't need help operating. The difference between the venture capital model and our VOM, venture operating model, is we operate. And when I say we operate, we put seasoned executives into your business and help you develop the business model that you want based on the goals you have and based on the scalability you're seeking. So a venture capital business or company generally says, here is X amount of money. I want 3 seats on your board, and I want quarterly updates. Plus, I need this return, and I need to have insight into everything you do. Venture operating model says, here's the money that we think you need to achieve your business goals that you and I have developed together. Here's how we're going to achieve it. Here are 3 people that you might be an idea person that came from marketing. You're a marketing whiz. I'll say, okay, well, we will give you a chief financial officer. We will give you a chief strategy officer. We will give you a chief technology officer to develop your business model. And in return, we get either you pay us for it, which is you do that, that's fine. Generally, you don't have the capital to do that, but we are open to it. 2, you give us some equity. Or 3, you give us a earnout clause, meaning I have a company that came to me and says, I don't want to give any equity to you, and I can't afford to pay you. So we said, okay, let's look at your business model. And we believed in it, and we said, we'll take a royalty payout until you've covered our costs. So we generally, I think the venture operating model is much more robust or more malleable than the technical definition of a VC.
Mm.
Now, to your question on how this came up, we have our management consulting company, and companies were coming to us and they're saying we need help, and we're looking at them and we say there's opportunity here. The challenge was they were not bankable. They weren't transparent businesses. I'll give you some examples when I say transparent businesses. We had a marijuana manufacturing company come to us. They had spent $2 million in a manufacturing facility. They had a contract signed, and we said, okay, interesting. And then when we started digging a little deeper, it turned out that they had some internal shareholder issues that made them unbankable. In order to fix that, that didn't scare us away because we saw the revenue model that could be generated out of it. In order to fix that, we had some criteria that needed to be hit in order to proceed, and transparency wasn't something that they weren't transparent enough. Let's put it that way. So there's all kinds of ways that we work with businesses, but the key part is operations. We understand it, we know what is needed, and the fact that you have money doesn't mean that you'll succeed. The most important part is strategy and culture. And there's the argument of which comes first. I say you need both. Because if you have a great culture but nowhere to run for, you'll be going in circles. And if you have just bad people in a room with a great goal, you're not going to achieve anything. So you kind of need both.
And Leon,
go
to
ahead.
follow up on that, and you probably have more to say on it, and I'll be curious to hear. I think this will tie in. I'm hearing a number of different layers of what you're able to offer. It sounds like there's flexibility with those you would be interested in entering into business with. And especially, I think the earnout idea is very interesting in terms of a model to come in and recognize that, you know what, we believe in your system, we believe in what you can generate for revenue. So we're going to push off the payday to later in time because we're confident that we can put in the proper systems combined with technological advances to get you to where we think you can go. One thing, and those words, technology and systems, to me, as I see it from the legal end, is so important to so many startups. And often it could be their downfall if they don't have those systems in place. And it can also be what sends them in the right direction for growth. My experience has shown me on those companies that I've worked with that the ones that have the systems in place, which this day and age, systems and technology are synonymous. I mean, you mentioned payment processing, you mentioned the automation system of interaction. You need that in order to position yourself for scaling. So one question I would have is, do you find that there's a very different approach to working with businesses that are not in the technology space versus those that are? Because you could still have a great, let's say, a fintech company that doesn't have systems in place, but you can also have a company that's not e-commerce, that's not in any technological field at all. And I would imagine that a systematic overhaul is necessary to put them in a position to succeed. Whereas maybe a tech company still needs your services, but the approach is going to be a little different. So I wonder if you see some distinctions there.
Yes, absolutely. It's an interesting question, actually, because take, for instance, the talent agency. No idea about technology and very set in their ways because they don't understand how technology can help. Now, on the flip side, when you have a technology company, you might have the opposite. They think technology can do everything for you. And there's a mix. We even have an internal debate every so often where some of my co-founders argue that every company is a technology company. And I disagree. I don't think every company is a technology company. A law firm, for instance, is not a technology company. But a law firm can benefit greatly from technology if it's done to make sure to help scale and to alleviate work of the attorneys working at the law firm so that they're more efficient and can see more clients, which leads to more billable hours, right? And helping more people. So to answer your question, what we tailor make our approach to what your need is. If you're strong in technology, we can help with the marketing side. What we do need, since the venture operating model is run through a fund, and I should probably go back to that. I'll finish this point and then go back to explain how the VOM works. But in order for us to provide capital, we also need to have some assurances that your company is going to work. Again, Taleb says minimize risk. We put executives from Hydrosoft in your company to make sure that the plan that we agree to happens and is executed against. Otherwise, we would be just like every other private lender or public lender or VC, where we write a blank check and say, come back at the board meeting and tell me how it worked. In our case, we have to have people in place that works with the business unit to make sure that we are hitting the milestones and that we are providing the success rate that we promised we'll get you, but also that we promised to get our investors. So I hope that answered your question.
No, I think it does.
So if I may just a little bit talk about the venture operating model and how we operate. We operate on a find, fund, and operate type of business model. Find meaning we look for projects to fund. Now, in order to fund the company, it has to be scalable. We've talked about that. And we have investors that invest in our venture operating model, Hydrosoft Ventures, and we are managing their money. The reason we need to have a fund, and this goes to Buck's question earlier also that I think I didn't answer appropriately, is we needed to act quickly. So Russ, for instance, you're starting up a dog walking business, just for sake of argument.
How did you know about my side business? Thanks for sharing.
So you need $10 million because it's a dog walking business across the world, across the US. So you come to me and you say, I have this opportunity. I need the money within 2 weeks because you have some time constraint that's related to getting this off the ground. That's a competitive advantage for us because we can give you the money quickly if we buy into it. So we then have aggregated in our fund capital. And when you come and ask us this, we need to be able to move quickly. So we're going to ask very strong and probing questions quickly to be able to see if we can reach an agreement. And if we can, we'll get you the money. So our investors that have provided the funds and capitalized our fund, they have a certain threshold that we need to meet every year in order for them to earn capital. So, for instance, there's a couple of ways to earn. You can earn an annual return on per year for your money. So it's really just debt financing. Or you can be an equity owner in an SPV, which is the special purpose vehicles that we set up. So your dog walking business would be a special purpose vehicle, and they can actually take a equity stake in your dog walking business. So we as Hydrosoft Ventures, we are going and we're really telling the investors, you're investing in us, Hydrosoft Ventures, and Hydrosoft Ventures is going out to and finding projects that we know can meet our income requirements and yours. So why we're so selective in which projects we choose is we're on the hook for the money. So we can't just write it off and say, sorry, it didn't pan out. We are on the hook, and that's why we call it a friendly acquisition, because we invest in the company and we're tied at the hip with you. So that's kind of how that VOM model, the funding part works. Then the next part is we find and we go through a discovery process with the projects. And normally that takes anywhere from 5 days to 3 weeks, depending on the project. And if everybody's hunky-dory and we've agreed on a North Star and everything's great, then we move into the fund process. The fund process is an engagement where we now really dig deep and figure out, okay, you need $1 million or $10 million for your dog walking business. The next 2-3 months, we're going to make sure we set up the exact milestone on how to achieve this. So call it a strategic plan. The final aspect of it is operate. That's delivering the results. This is where we work together with the executive team as the executive team to make it happen. And that time period is between 3 to 5 years, and it leads up to an agreed upon exit event, whether that is IPO, whether that's selling the company, maybe that is buying Hydrosoft Ventures out of your equity ownership position. Whatever we've decided as a group between the founder and the Hydrosoft Venture, that's the exit event. So remember, find, fund, and operate. Those are the 3 aspects of our anti-fragile venture operating model.
Well, and there's another interesting component to this, and I think every company has their special sauce when it comes to the discovery process, as you called it, which I assume is the due diligence aspect of deciding whether or not to take on a new venture, without, obviously sharing anything that's internal to Hydrosoft's, I guess, trade secrets, for lack of a better word. I'm speaking in legalese here. But what is your strategy for due diligence when looking into a new venture? Is there a, should I say, a system in place? Are there certain thresholds or key factors that everybody considers? Or is it something that really is just based on the industry of the business, based upon the growth or the size of the business, that's going to change every single time?
It's a great question. It's generally speaking a very what's it called? We sit down with the management team. So it's a very iterative process. We say, okay, you need $1 million. You've sent us a deck. We've gone through it, and we say, okay, this is an interesting one. Ross, for your dog walking business, let's talk. And we set up a 3 to 5 day, workshop where we sit down and actually go through everything you want to achieve and why you believe you can achieve it. So it's more of a you download all the information that you believe that makes your business scalable, and we sit and then take in all the information, ask questions, clarifying questions, and since speed is of the essence, we have to do this quickly. So we'll put 3-5 people in a room with the founder and just shoot questions back and forth. And then at the end of the discovery, we come back with a solution on how we think we can achieve your North Star, as I like to call it. So if your dog walking business is to become a global company and go IPO, we set up how you would achieve that in broad strokes. And once we buy into that, we give you a proposal for our engagement. And that's the second part, where we package the deal into something that we can then go to our fund with and say, this is what we have invested money in. Here's how it's going to work. Here's all the details behind it in case you're interested. Mm-hmm. So the discovery is it's the paramount part of all of these projects we look at. And recall from the conversation on the venture operating model and Hydrosoft Ventures responsibility and fiduciary responsibility for the cash that we manage or capital that we manage, we are very selective, and it has to meet our criteria for meeting our for paying our preferred dividends or even for achieving an exit for our investor.
I'll follow up a little bit on that, Leon. Uh, you explained the initial parts, you explained the due diligence process, you explained how the funding, different approaches you take, little much more flexible than what is typically available in the marketplace. So as you know, our members are primarily fintechs, and let us say we have got a banker who has spent good 10, 15 years in a bank, has become subject matter expert in a particular area of bank. And let us say he comes up with an idea that today, let us say when a bank onboards a new corporate customer, let us say there is a typical 5 to 7 business days of onboarding process. The know your customer stuff and the AML and OFAC and all that stuff. It's complex, it takes a lot of time, but this guy is insightful, he has seen a lot of things. He has got a model that, okay, I can do it in 72 hours. That's the kind of model he's looking at. He has got a good functional understanding of how it can be done, but he has no technical ability to architect that solution or ability to develop that solution. So your technology skills, your architecture skills, your operating model, and your funding, these 4 things you talked about. So are these the 4 things your package, or you can go to the next step and also help run the marketing process, the sales process, the winning of the customers, because we have many members, who are very good subject matter experts, but not necessarily people experienced in sales or marketing or support operations, those kind of things.
Yep, that makes sense. The answer is we provide range, and there's a book that I'm fascinated with by author David Epstein, and it's called Range. And what it explains is subject matter experts are generally the worst people at solving problems in their own industry. The reason being, they only see and they're experts on what they know. So trying to think outside of the box is difficult. So a PhD with for rocket science, for instance, it might be very bad at figuring out food packaging because the range isn't there. So our approach to the VOM and for the execution and operational side is bring in subject experts from a wide swath of industries, which is who we are and who we operate with, and then solve your specific challenge or opportunity. So talking about marketing, we can market based on technology or based on product. It does not matter, because again, it has to be scalable and it has to be understandable. So range is a differentiator for us as well.
Mm-hmm. Excellent.
So if you haven't read that book, by the way, I'm not always a person to recommend books because everybody is might have different opinions. But this is a book that even I have children and they're all basketball players.
Okay.
And the question is, do you just train them in basketball or do you allow them to do different things to get hand-eye coordination, to get team spirit, to get brain activation? And when I read this book, it's clear to me that if you want to develop a person, whether an executive, an individual, or whatever, to be the most effective, subject them to a bunch of different difficult tasks so that later on, when they're faced with something in one industry, they can draw upon a solution that they found in a third industry, right? And that is the venture operating model that we have. I gave you a couple of examples. We work in technology, we work in healthcare, we work in e-commerce, we work in fintech, and all of it have common denominators that you can bring in and target when it comes to banking, for instance, in your example?
I just have a point that I want to mention. So, you know what, we do have a number of people, before we kind of move on to the next questions, we want to give the audience an opportunity. Perhaps maybe they may have some very specific questions for any one of us, obviously. So if anyone has a question that they would like to pose, you can either send it through chat and we could read that question, or you can turn yourself on to speak and you can ask that question directly. Just kind of give you a few seconds to kind of think about that you may have a question. Anyone?
Yeah, they'll take some time to think. Yeah.
Yeah, absolutely. Okay, I just want to make sure that we provide an opportunity for the audience if they have any questions, because a lot of the information that Leon, that you have mentioned, probably many may not kind of think about that consistently when they think about an operating model for an e-commerce company or fintech. So when I first heard of the operating model, I was not as absolutely as clear as I am now, but I think there's a lot of value. And whether a fintech, e-commerce, or a small business, obviously kind of thinking how they could be energize their company, or ways they can look at the company differently. I think that Hydra Ventures is providing that. So I just kind of want to think about, someone may have some questions along that they may want to ask, or we can continue asking some of the questions that the panelists may have for you as well. And again, if anyone comes up, we can always use their chat feature.
To that point also, Wayne, I'll put an open invitation on this call and say, if you have ideas, you have questions, feel free to do one or two things. Number one, go to our hydrasoftventures.io website. It has a lot of the information on there in detail. Option two is, if you have something that you think we might be able to help with, I am making myself available to have a conversation with you. So Leon at hydrasoftventures.io, and you can get a hold of me and send me an email, and then we'll get on a phone call and have a conversation. This is about helping, and obviously the more we help, the more we earn. So it's a mutual beneficial thing to do. So free consultation if you're interested.
Okay. Thank you.
Thank you for that.
Yeah. I got my marketing and sales skills in there a little bit.
So now I know if people can, you can definitely help with sales and marketing. I got the answer.
Okay. Leon, I think the remainder of our audience, we do have an audience that, appears on different webinars where we showcase different speakers. And as you're one of them, we'll certainly be sharing our time with you, with the entire audience. As for the model, I would agree with Wayne. I think that, there's a lot of startups, I think they become discouraged over time. And for better or for worse, being on the legal end of things, I get to see sort of the first elements of, we're raising the capital, the money's coming in, and then now we're starting to kind of build up. But often there's a lack of direction. And as we mentioned with the typical VC structure, sometimes, there's a board involvement, but a lot of the times there just isn't that aspect of oversight. There isn't that aspect of recommendations, and there's not that close-knit relationship that it sounds like, as a necessity, Hydrasoft brings to the table when selecting an underlying business to work with. So I think the value is there. And it's important for certainly our audience to understand what a company such as yours can offer them. So I think there's been a lot of value in this.
In fact, Ross, just to add a little bit to what you said, it is so disheartening when you see some of the things that happen to very good entrepreneurs. I was recently working with an entrepreneur almost for 2.5, 3 years. And in fact, just a few days ago, I wrote a LinkedIn post about the workflow solutions that the world is so fascinated with. Everybody wants to develop something in workflow. And, people think about SharePoint and this and that, and they say they are so inefficient. I can do something much better. So everybody tries. But it's a very sad state. And I was talking to an entrepreneur. I tried to help him for almost 6-7 months. Ultimately, both of us realized it was not going to go anywhere. So, he developed a workflow solution for the financial services industry. Very complex, very good thought. And he put it on a certain platform. Let me not name that now here. And after he did that, spent a lot of money from his own pocket and a couple of investors, got some big piece developed. and then nothing is actually working on the ground. So then somebody introduced him to me. I was looking at what he was doing. And I really want all of you, all our audience members, not only on the webinar today, but when we share it with them, to listen to this carefully, because it doesn't sound even possible that something like this can happen. So I asked him, why did you select this platform? Because to me, it looks so completely inappropriate for what you're trying to do. And he looked at me and he thought about it and he said, frankly, I don't have an answer, but somebody told me it was good. It is that bad, and it is so sad that people spend so much time and money, and they put in their blood and sweat, and some very foundational level mistakes just don't allow them to make anything out of it. That's the sad part. So Leon, I was going to follow up with one more question there, that when you get involved vis-a-vis, let us say, a VC getting involved. So the VC has signed an agreement, term sheet, he has given some money, he or she has agreed to put some funding and revenue matching milestones in the middle, all that stuff. But one thing in the VC relationship is that the VC is not responsible for results.
Amen.
Right? Whereas in your case, you are saying that I'm also getting involved in delivering results for the venture. So then how do you assign or distribute the targets or the responsibilities? Or because at the end of 3 years, when everybody has put in a lot of effort and blood and sweat, there's no point in quarreling whether pointing the finger at me or you or him or him. That doesn't make any sense to anybody. So how do you kind of think through this and work with the entrepreneurs to come up with a rational allocation of responsibilities?
Right. So you're absolutely right. We have skin in the game, and we are risking our fund's reputation by joining a enterprise project. So our skill set, our competitive advantage is operations. And when I say operations, I'm not talking about supply chain moving a box, which is a very important part too. But operations means soup to nuts, starting at your idea all the way to delivering. We are involved. And if we give Russ for his dog walking business $10 million, we need to have a plan that on how to achieve at least 11 million to pay back our return, right? And hopefully much more than that. So failure to us is not an option, because we fail once and we're done. So why we go through the rigorous discovery process is to make sure that Russ, as an entrepreneur, knows what we are going to ask him to do in order for us to help him achieve his goal. So if you think about it, Russ is leasing our expertise and giving up some form of compensation, whether equity or whatever, for our expertise. And we are investing both time, effort, and money into his company. And what we're trying to do is minimize his risk and maximize both of our wealth. So this is something that you get nowhere else. I'm going to state it again. We cannot afford to lose our investors' money. It's not I'm going to take a approach, spread some money across 10 companies, 9 of them fail, which is a real statistic, 90% failure rate. And 1 is a unicorn that pays my company for all the failures that I invested in. So we're not in the percentage game. We are in picking projects that have very high likelihood of succeeding according to our anti-fragility value proposition. We normally target healthcare, technology, e-commerce, and those 3 are, and variations of those 3, because Pandemic hits, shipping's not going to be a problem. Pandemic hits, Amazon is going to do really well because they're selling online. They don't rely on stores being open. Food business, same thing. Anti-fragility makes sense to us because we're not going to Las Vegas with your money and with your project. So that's the one where we are we're in the same boat with you, and we better all be rowing in the same direction. And that's where the discovery, the engagement, and the operation process all tie together. But it only works if everybody's aligned on the strategy, which is the beginning point of everything we do. I hope that answered.
Mm-hmm. Yeah, thank you for that. Wayne, you were asking something?
No, I think that this is very valuable. So just kind of curious, does anybody have, from a concluding standpoint, any questions at this particular point before we conclude? I think we've covered this very nicely. A lot of information obviously was exchanged. We did open it up to the audience if they have any particular questions. Ross, Buck, just as a concluding comment, do you have any thoughts?
That's no, I'll simply add for all our members that, it was a lot to process in last 45, 50 minutes, but we are going to send you information with some decks that Hydersoft is going to provide us. And as all of you know, Leon has offered to get on a call with you if you want to ask any questions, if you want to get some clarity on how the model can work, because it is something that we very passionately believed for last 4 or 5 weeks, all of us, that we need to put in front of all our members, that you got a great idea, you have spent 15 years in your own line of business, you want to do something, but converting that idea into a real working profitable business is a very different thing. And there is professional help available that you can reach out to any one of us, reach out directly to Leon, whichever way you want. But I would suggest that take full advantage of this opportunity that is in front of us. Know more about it, how it works, reach out to Leon, ask him questions, and of course we are going to send you some information, because we believe that if you're not a full-fledged team, like you're a startup team of 6 people, you've got a CTO, CIO, CFO, everyone available right from day one. But frankly, if that was the case, then you wouldn't be a startup in the first place. So if you are a startup, obviously you don't have some of those things. And here is a company that is willing to help you on a compensation, deferred compensation, revenue sharing, equity distribution kind of basis, rather than demanding upfront money. So definitely study that and take advantage of that. That's what I wanted to put in front of all our members.
Yeah. And one of the things to add is that we're also going to make this available on our BSFI Tech Talk platform, as well as our LinkedIn group. So it'll create some additional exposure to not only our members, but also our prospects. So again, Leon, thank you so much for your time. We do appreciate sharing this information, and we look forward to continuing to follow you in the trajectory of your own growth as well. So thank you. And thanks to everyone who has joined and participated in our discussion.
Thank you, everyone.
Nice point from one of our participants. Great and practical insights on moving ideas to execution. Thank you very much for that.
That was exactly the idea. Exactly right.
Okay. Thank you.
Thank you for your time. Appreciate it. Thank you, Leon.
Thanks
everybody. Bye-bye now.
Have a good afternoon, everyone.